Hey guys, Julian here from Ripehouse. Today we're going to get into borrowing mistakes and what are the common mistakes that I see investors make when it comes to arranging their investment strategy and their finances moving forward. And for mine, this is actually one of the most important things you need to do when you're setting up your property portfolio. I would actually say it's nearly as important as the asset selection piece. If you get your strategy incorrect at the beginning from structuring your lending, going into the right loan, right product, you can cost yourself tens of thousands of dollars each and every year. So you really need to understand that there's sophisticated strategies, and then there's brokers, there's investment lending specialists, and what are the key differences. But I guess before we get too much into that, want to talk about why it's important and understanding there's a big difference in the market. Because as we go to here, we've obviously had some serious rate increases over the past 2 years, but the big four are kind of laughing all the way to the bank, no pun intended. We're seeing all of them 40% year-on-year increases in terms of profits. So great if you're a shareholder in these stocks, but we can see there's a huge increase in their profits in the last year. And the thing that I just try and let people know is, there is actually no cost associated in most instances when sitting down with a broker investment lending specialist. They are there working, typically speaking, with a panel of providers, and they should be, if they're doing their job correctly and they don't have any ulterior motives, getting back pocket deals, etc., presenting you with the best options that are available to you in the market and also bespoke to your situation. Probably the most common mistake that I see, and I'll put my grumpy pants on here for this one because I had one very upset prospect in the last probably month where very, very kindly just suggested, because they had a friend of a friend who knew somebody at a local branch. They're definitely on this screen, and they'd set up everything for them, and they told them, don't speak to anybody else, we'll take care of you. Well, for me, that's flashing alarm signs. It's no different in terms of, you going to the corner hardware store. Yes, you might get better service, but at the end of the day, all they can sell to you are the products that they have available to you. Where if you're going to a massive hardware store, firstly, you might get better prices just based off the availability of stock available to you, but also different options which might be bespoke more so to your needs. So you don't actually know unless you actually shop around and get differing advice, and there is very, very different strategies that can come along the way into lending, but I won't get too much in that. It costs you nothing. You are really doing yourself a disservice if you're just walking yourself into a bank and I think it's kind of lazy planning in a way, because it's very easy, and I can understand. I call it climbing the top of Mount Paperwork when it comes to getting your finances in a row, because it can be one of the most tiresome parts of it. You've got to upload all your documents, get your IDs, get things certified, etc. But if you get it wrong at the beginning, you can't reverse and go backwards. You can refinance, but if it's not structured correctly at the beginning, it costs you a lot of money. So you should always be getting that second opinion. And you know what? You may actually be better off going to one of these guys, and it might be the best product for you at the time. But if you don't get that second opinion, you're never actually going to know. And the reason that is really important as well is because understanding there has been significant changes in borrowing capacity over the last couple of years. So we can see for most people, if we have a look here, most people have lost over 30% of their borrowing capacity in the last couple of years. Now, interest rates have increased. That has still not seen property market prices drop. We're sitting at all-time highs in most markets, if not all markets at this point. So that has not had an impact on pricing. So imagine what is to come ahead, because we're already flagged for rate cuts, or at least rate pauses. In this period where we've been losing borrowing capacity, consumer confidence has fallen to the floor, but we still saw house prices move. Now we're going through this period where rates have stabilized, and we're seeing an increase of inquiry when it comes into investment properties and even places just to purchase, to live in. That is going to continue to go up. If we see rate cuts, a 1% rate cut is typically about a 10% increase of your borrowing capacity. Now, to compound this, if we are to see potentially some introduction of new lending products in the markets. Potentially lenders may move from 30 to 35 to 40-year loans. There are already some, we'll call them smaller tier lenders offering such products. That can increase your borrowing capacity. If the interest rate buffer is reduced, APRA has changed that before. They've moved the goalpost from 2% to 3%. If that comes back down, that gets you another 10% of your borrowing capacity. But it's also really important to understand that there's also stage 3 tax cuts coming in this coming financial year. So why that matters is because you're going to have a vast majority of the public that this affects. We've probably heard plenty of news stories about it that, you know, the higher income earners aren't getting a big of a cut because they've reduced that down to the lower income earners. Now, where you sit on the fence, it doesn't really matter. That's kind of irrelevant for this topic. But what it does mean is that it actually is applied now to more people in the population. So there are actually going to be more people impacted by these stage 3 tax cuts, which in turn will have more people having more borrowing capacity available to them. And history tells us when we have more borrowing capacity on our side, so back when interest rates were basically zero, or we have a, we'll call it a barrier to entry reduced. So that can be things like stamp duty concessions, government grants, etc. That typically sees house prices further stimulated because you don't have to have that barrier to entry stopping you to get into the market. In this instance, you might see your borrowing capacity go from 400 to 450 or 600 to 650. So people are just going to be able to get into higher priced assets, might be able to just get into the same asset, but they'll gradually push those prices along. So you are doing yourself the biggest disservice if you're not getting yourself the right advice. Do not make these mistakes of just going to your bank. And I have to say, hand on heart, I have been that person in my property investment journey early on. You know, I went straight to CBA. I had a Dolomite account back when I was a kid. That's how they get you. They want you hooked in there at the very beginning. You walk on in. They don't need you to supply anything because all your bank accounts are with them. You just need to give them your couple of pay slips, which they basically already have on file anyway. And it's the easiest loan process approval you come across. But easy isn't always best. So just keep that in mind when you are thinking about what your strategy is going to be and what's going to be best available to you when you're getting your investment strategy set up for you. So guys, I hope you enjoyed this video. Maybe you're employed by the Big Four. Not to make any enemies, but we'd love to get your comments on this one below. Please leave that below. If you haven't already, make sure you smash that like button and hit subscribe. And looking forward to speaking to you on the next one. Bye for now.